Welcome to Muscular Brain, Fat Wallet. Today, we're diving deep into a topic that is essential for anyone considering homeownership or real estate investment: types of mortgage loans. Understanding the different types of mortgage loans available can save you a substantial amount of money and help you make informed decisions about your financial future. Buying a home is often one of the most significant investments you'll make in your lifetime. The type of mortgage you choose can greatly impact your monthly payments, the total interest you pay over the life of the loan, and your overall financial strategy. In this guide, we'll cover a variety of mortgage types, from fixed-rate and adjustable-rate mortgages to government-backed loans and beyond. Choosing the right mortgage is crucial. The terms of your mortgage will determine not only how much you pay monthly but also how much you will pay over the entire loan period. It can affect your cash flow and your ability to invest in other opportunities. Let's explore the different mortgage options available, their benefits and drawbacks, and help you find the perfect fit for your needs. Section 1. Fixed-rate mortgages. 1.1 Overview. Fixed-rate mortgages are perhaps the most traditional type of mortgage loan. With a fixed-rate mortgage, the interest rate remains constant throughout the life of the loan, typically spanning 15 to 30 years. This means your monthly payment for principal and interest will remain the same, providing stability and predictability in budgeting. The fixed-rate mortgage is appealing to many homeowners because it allows for consistent payment planning. Borrowers can accurately budget their finances without worrying about fluctuating interest rates. 1.2 Benefits. One of the primary benefits of a fixed-rate mortgage is the assurance that your interest rate won't change, no matter how the market fluctuates. This is particularly advantageous in a rising interest rate environment, as you can lock and allow a rate for the duration of your loan. Additionally, the predictability of fixed payments can help you plan your long-term finances more effectively. This stability is comforting for many homeowners, especially first-time buyers who may be anxious about their financial commitments. 1.3 Drawbacks. However, fixed-rate mortgages can come with higher initial interest rates compared to adjustable-rate options. If you secure a fixed-rate mortgage when interest rates are low, you might miss out on potential savings if rates drop in the future. Moreover, if you wish to sell your home before the mortgage is paid off, you might be locked into a higher interest rate compared to current market rates at the time of your sale. 1.4 Ideal candidates. Fixed-rate mortgages, ideal for long-term homeowners who plan to stay in their homes for many years. If you value stability and wish to avoid surprises in your mortgage payments, this option may be the right fit for you. Individuals who prioritize predictability over potential cost savings will find this type of mortgage appealing. 1.5 Real-life examples. Let's consider the case of John and Sarah, a young couple looking to buy their first home. They opted for a 30-year fixed-rate mortgage with a rate of 3.5%. This provided them with a stable monthly payment of $1,200, allowing them to budget effectively and enjoy their new home without worrying about fluctuating interest rates. Even after 5 years, when interest rates increased to 4.5%, they felt secure knowing their payment would remain the same. John and Sarah found peace of mind in their financial planning, allowing them to invest in their children's education. Section 2. Adjustable Rate Mortgages, ARMs. 2.1 Overview. Adjustable Rate Mortgages, or ARMs, are designed with a lower initial interest rate that is fixed for a specified period, usually 5, 7, or 10 years. After this period, the rate adjusts periodically based on market conditions, which can result in changes to your monthly payment. ARMs typically start with lower interest rates compared to fixed-rate mortgages, making them an attractive option for many homebuyers, especially in a competitive market. 2.2 Benefits. The main benefit of an ARM is the lower initial interest rate compared to fixed-rate mortgages. This can lead to significant savings in the early years of your loan, especially for borrowers who plan to sell or refinance before the rate adjusts. For example, a 5/1 ARM might offer an initial rate of 3% for the first 5 years. After that, the rate adjusts annually based on an index plus a margin set by the lender. 2.3 Drawbacks. However, the unpredictability of future payments is a key drawback of ARMs. If interest rates rise significantly after the initial period, borrowers may experience payment shock, leading to financial strain. For example, if interest rates rise to 5% after the initial fixed period, monthly payments could jump significantly. Moreover, some ARMs have caps on how much the interest rate can increase each year or over the life of the loan, but this still means that borrowers are exposed to potential rate hikes. 2.4 Ideal candidates. ARMs are suitable for buyers who plan to stay in their homes for a short time or those who expect their incomes to increase significantly in the future. If you can handle some risk and prefer the potential for lower initial payments, an ARM may be a good choice. Young professionals or individuals anticipating a career change that may require relocation are excellent candidates for this mortgage type. 2.5 Real-life examples. Consider Emily, a tech professional who bought her first home using a 7/1 ARM. With an initial interest rate of 2.8%, she saved significantly in her first few years, allowing her to invest that money elsewhere. Emily planned to move within 7 years, making this loan type a perfect fit for her financial situation. After 7 years, she refinanced before the rate adjustment, securing another low-rate mortgage, which further enhanced her savings. Section 3. Government-backed loans. Government-backed loans are a popular option for many homebuyers, particularly first-time buyers or those with limited credit histories. These loans come with various benefits, including lower down payment requirements and easier credit score qualifications. 3.1 FHA loans. Overview of FHA loans. The Federal Housing Administration, FHA, offers loans designed to help lower-income individuals or first-time homebuyers achieve homeownership. FHA loans allow for down payments as low as 3.5% and often come with more lenient credit score requirements. Benefits. 1. Lower down payment requirements make homeownership more accessible. 2. Flexible credit score requirements enable more individuals to qualify. Drawbacks. 1. Borrowers are required to pay mortgage insurance premiums, MIP, which adds to the overall cost of the loan. 2. FHA loan limits vary by location and may restrict the price of the home you can purchase. Ideal candidates. FHA loans are best suited for first-time homebuyers or those with lower credit scores seeking to buy a home without a large down payment. Real-life example. A young couple, Jake and Lisa, qualified for an FHA loan, allowing them to purchase their first home with just a 3.5% down payment. Despite having a lower credit score, they could secure a loan, making their dream of homeownership a reality. 3.2 VAloans. Overview of VAloans. Loans backed by the Department of Veterans Affairs, VA, are designed to assist veterans and active duty service members in purchasing homes. These loans typically require no down payment and do not require private mortgage insurance, PMI. Benefits. 1. No down payment and no mortgage insurance, reducing the cost of homeownership. 2. Competitive interest rates compared to conventional loans. Drawbacks. 1. Only available to eligible veterans and service members. 2. Requires a VA funding fee, which can be financed into the loan. Ideal candidates. VA loans, ideal for military personnel and veterans looking for affordable housing options without the burden of significant upfront costs. Real-life example. A veteran named Mike purchased a home using a VA loan, taking advantage of the zero down payment feature. This enabled him to preserve his savings for other investments while enjoying the benefits of homeownership. 3.3 USDA loans. Overview of USDA loans. The U.S. Department of Agriculture, USDA, offers loans to promote homeownership in rural and suburban areas. These loans typically require no down payment and come with competitive interest rates. Benefits. 1. Low interest rates and no down payment requirements make homeownership attainable for eligible buyers. 2. The USDA guarantees a portion of the loan, which reduces the risk for lenders. Drawbacks. 1. Property eligibility is limited to designated rural areas. 2. There are income limits that may restrict higher earners from qualifying. Ideal candidates. USDA loans are perfect for individuals looking to buy homes in rural or suburban locations and who meet the income eligibility requirements. Real-life example. Jessica and her family secured a USDA loan to buy a home in a rural area, allowing them to avoid a down payment and save on interest costs, making their homeownership dream a reality. 3.4 Ideal candidates for government-backed loans. In summary, government-backed loans provide significant opportunities for first-time homebuyers, veterans, and individuals in rural areas. If you fit any of these categories, consider exploring FHA, VA, and USDA loans as viable options for home financing. Section 4. Interest-only mortgages. 4.1 Overview. Interest-only mortgages are a unique type of mortgage that allows borrowers to pay only the interest for a specified period, typically between 5 and 10 years. After the interest-only period ends, borrowers must start paying both principal and interest, which can lead to significantly higher payments. 4.2 Benefits. The primary benefit of interest-only mortgages is lower monthly payments during the interest-only period, making homeownership more affordable initially. This can be appealing for buyers who expect their incomes to rise or who plan to sell their homes before the payment increases. 4.3 Drawbacks. However, interest-only loans come with risks. Once the interest-only period ends, borrowers face a sudden increase in monthly payments, which can strain their finances. Additionally, borrowers do not build equity during the interest-only phase, potentially leading to situations where they owe more than the home is worth if property values decline. 4.4 Ideal candidates. Interest-only mortgages may be suitable for high-income earners who have variable income streams or those who plan to sell the home before the interest-only period ends. However, borrowers should be cautious and thoroughly assess their financial situation before pursuing this option. 4.5 Real-life examples. Consider David, a successful entrepreneur who took out an interest-only mortgage on a luxury home. Initially, his payments were significantly lower, allowing him to invest his cash flow into his business. However, when the payment increased after 5 years, he had to sell the home to avoid financial strain, highlighting the risks of this mortgage type. Section 5. Jumbo mortgages. 5.1 Overview. Jumbo mortgages are non-conforming loans that exceed the maximum limits set by the Federal Housing Finance Agency, FHFA. Because these loans are not backed by Fannie Mae or Freddie Mac, they typically come with stricter credit requirements and higher interest rates. 5.2 Benefits. The main benefit of a jumbo mortgage is the ability to finance high-value properties, allowing buyers to purchase homes in premium markets. Additionally, they can provide financing for properties that do not conform to conventional loan limits. 5.3 Drawbacks. The drawbacks of jumbo loans include stricter credit requirements and larger down payment requirements, often ranging from 10% to 20%. Additionally, higher interest rates can lead to increased monthly payments. 5.4 Ideal candidates. Jumbo mortgages are best suited for high net worth individuals seeking to purchase luxury homes or properties in high-cost areas. If you have a strong credit profile and can afford the higher payments, a jumbo loan might be an excellent option. 5.5 Real-life examples. Sophia, a successful business executive, purchased her dream home in an affluent neighborhood using a jumbo mortgage. Although she faced a higher interest rate, her strong credit profile allowed her to secure the financing she needed for her ideal property. Section 6. Conventional loans. 6.1 Overview. Conventional loans are mortgage loans that are not backed by the government. They typically come in two forms: conforming loans, which meet the guidelines set by Fannie Mae and Freddie Mac, and non-conforming loans, which do not. 6.2 Benefits. Conventional loans often come with lower mortgage insurance costs compared to government-backed loans. They can also offer more flexible terms and conditions, providing borrowers with various financing options. 6.3 Drawbacks. However, conventional loans typically require higher credit scores and down payments than government-backed loans, making them less accessible to some borrowers. 6.4 Ideal candidates. Conventional loans are suitable for borrowers with good credit scores and sufficient funds for a down payment. They may also appeal to those seeking a more straightforward mortgage process without the complexities of government-backed loans. 6.5 Real-life examples. Tom and Linda opted for a conventional loan to purchase their new home. With a solid credit score and a 20% down payment, they secured favorable terms and enjoyed the benefits of lower mortgage insurance costs. Section 7. Reverse mortgages. 7.1 Overview. Reverse mortgages are designed for homeowners aged 62 and older, allowing them to convert a portion of their home equity into cash without selling their home. This can provide additional income for retirees, helping them cover living expenses. 7.2 Benefits. The main benefit of a reverse mortgage is the ability to access home equity without monthly mortgage payments. This can be a valuable financial tool for retirees who need extra income. 7.3 Drawbacks. However, reverse mortgages can be complex and come with fees that can reduce the overall equity in the home. Additionally, the loan must be repaid when the homeowner moves out, sells the home, or passes away, which can impact heirs. 7.4 Ideal candidates to reverse mortgages, ideal for retirees who have substantial home equity and need additional income to support their lifestyle. However, they should be approached with caution and thorough understanding. Section 8. Conclusion. In conclusion, understanding the different types of mortgage loans available is crucial to making an informed decision about your home financing. Each mortgage type has its benefits and drawbacks, and the right choice for you will depend on your financial situation, long-term goals, and risk tolerance. Whether you prefer the stability of a fixed-rate mortgage, the lower initial payments of an ARM, or the unique advantages of government-backed loans, being informed is the key to navigating the complex world of home financing. At Muscular Brain, Fat Wallet, we hope this guide has provided you with valuable insights into mortgage loans and helped you understand which type may be the best fit for your needs. Thank you for tuning in. Don't forget to subscribe for more insights and tips on navigating the complex world of finance and real estate.